Kaseem here. Welcome to today's video. In today's video, we are gonna talk about moving averages. Okay, we're gonna talk about different moving averages. We're gonna talk about the 10 moving average, the 15, the 50, the 100, and the 200 moving average. So stay tuned. It's gonna be a fun educational video today on trading. So thank you for checking out the video. Subscribe, like this video, and yeah, let's get straight into the video. Hello everyone, welcome back to the computer screen. In the previous video, I'm recording this back to back. So in the previous video, we talked about these two right here. This is the 10 moving average, this little dots. That's the 10 moving average. And this red line right here, that's the 15 moving average. So now I have three more moving averages to add: the 50, the 100, and the 200. And I'm going to show you the reason why I'm adding those in 1 second. Just give me a second here. So we're going to go to, obviously you're going to go to edit studies. That's the cup lab looking cup on TOS, Thinkorswim. Move average of exponential. So we're gonna add 3, right? 1, 2, 3. Okay, so it will be right here. So this first one, we're gonna change this to the number 50 because we want the 50. We want the 50 moving average. So we're gonna change this to 50. These things, they move so fast, so pardon me there. And I'm gonna change this to yellow, and you don't even have to make it thick or anything like that. You can just leave it the exact way that it is. And here we are going to make this 100, and we're gonna make this, which color can we make this? Okay, I'm gonna make it this blue, and I'll leave it at that. Say okay, and we are gonna make this, change this to 200. And I'm using those averages because those averages are like the most commonly used on Wall Street. So professional traders that trade for the banks and stuff like that, they use it as well. I've picked up a bunch of professional traders before, interacted with them, and they say they use it and they swear by it for the most part. So that's why I like to keep an eye on it as well. And you'll see why, because sometimes a stock can go all the way down to the 200 and bounce off the 200, to go back up. So that's pretty much it. I mean, you don't necessarily need to have it in there. You don't really need to, but as you can see right here, without having the 50 there, for example, here that we have the 50, without having the 50 here, you're just like, okay, why is it that a couple is not moving downwards? It's just staying here. The candles, like, why is it that these candles are not going further down? They just kind of staying here on this kind of like this, like consolidation. It is basically consolidating off of the 50 moving average, off of the 50-day moving average. So like we said in previous lessons, for the moving averages are just basically there for you to show, for you to be able to see resistance and support. Sometimes price can be within the moving averages, and it will act as a easy way to look at resistance and support and resistance. Okay, this is a good example here. Like right here, the price, this is the 50 moving average, this yellow one, that's the 50 moving average. The price basically right here, it basically served as support and resistance right here. Support and resistance, and you have the 100 in the middle. So the 50 becomes the resistance. That's the very top, that's the highest that the price has gone. If we look around this area, you see the 50 and the 100 becomes the support and resistance, and it broke the 100 here, and it pushed down, came all the way down to the 200. This blue line is the 200 moving average. It came down and broke to it, bounced off of it, came down the first time, the second time kind of bounced off of it, and then kept on pushing up. So that's what the moving averages are for. It helps you identify like levels of support and resistance, like between here the 15 and the 50. That's the support and resistance level here as well. So it just makes it easier, and it's just built in, so you don't have to like do it yourself. Same thing here. If I had the wicks on here, the wicks would definitely, let me see if I can quickly show you guys by adding the wicks to this. Let me add the wick to this, so it's easier for me to explain to you guys. But I don't like to use the wick, so personally on my chart anyways, I don't like to use the wick. There you go. This is the area that I was talking to you about right here. So the first week so price go as low and touched the 200, bounced off, kind of slowed down, pushed down. This one touched the 200, came up again, then pushed down again. So the moving averages, these key moving averages here are very, very important. You know, these are the key moving averages: the 10, 15, 50, 100, and the 200 moving average. The 10 and 15 are more closer to the chart because it helps you identify where you should be taking trades. And then the 50, the 100, and the 200, it helps show you support and resistance on a larger time scale. Yeah, so that's why I use it. I think it's nice to use. It makes it a lot easier to see on the eye. But I'm gonna take off the wicks from here because I don't like the wicks. It makes the chart looks crazier than it's supposed to be. so yeah, that's how I use it. I use it as support and resistance. This blue line is 200. This line right here is the 100. The yellow line is the 50, and as we explained before, this dotted line is the 10. This red line is the 15, if I'm not mistaken. So yeah, you know, you use it as support and resistance. Like right here, you can see if you take a trade here, it bounced off the 100, kind of stick with it, stayed there. Then the next chart, the next candle started right on top of the 50, then started coming back down all the way until the chart hits the 200, and then bounce off it and head back up. So that is how I use moving averages for support and resistance. So yeah, that's the end of the video. Let's get into the next bit of context. I always like to do this. Refer to an article down in the description below that you can read, because this video is educational video that is solely geared towards educating you about some of these topics that is very important if you are interested in trading. You know, so moving averages are actually an important aspect of trading. You need to know what they are, how to use them, and all these things. So it's very important that you learn how to use them. So I'm going to leave this article in the description for you to read. It gives you all the details about all the different types of moving averages, their formulas, and all these things. But let me quickly play this video for you. This is a brief explanation of how it works, so you can get a better understanding in a couple of minutes on how to use it. So let's get into it.
Moving average is a technical indicator that refers to an average price for a particular trading instrument over a specified period. Moving averages are used by investors and traders to track and identify trends by smoothing normal day-to-day price fluctuations. There are various moving average lengths. A 20-day moving average, for example, calculates the average price of a specific instrument over the past 20 days. A 20-day moving average can be seen here as the blue line. Investors can use this line as a support or resistance level indicator and base trades around it. Moving averages are calculated by adding up the previous X number of periods and dividing that sum by the total number of periods. For example, a 5-day moving average is calculated by totaling the previous 5 days' price data and dividing by 5, a simple arithmetic mean. Each time a new period occurs, the moving average moves forward, dropping the first data point and adding the newest one. As a technical indicator, a moving average appears as a smooth, curving line that provides a visual representation of a stock's longer-term trend. Faster moving averages with shorter look-back periods are choppier. Slower moving averages with longer look-back periods are smoother.
So I hope you've learned something from that. That is just they do a better job explaining a lot more than I do, but I try to explain things in my way, so they can explain it in a more professional way. So that's why I show this video, so you can have an idea of what it is and how to use it and why I'm using it. So let's get into the next segment of this video. Be back in a second. Thank you for watching. I hope you've learned something from that short lesson. If you've learned something, please give the video a thumbs up. If you like what I'm doing here, give the video a thumbs up. Subscribe to the channel. Stick around for a lot more videos like this. A lot more lesson video like this set up to help everybody that don't understand charts or use chart. I'm just sharing my knowledge. This is how I use my chart. This is how I've developed it. You might think this is not understandable, or you might think it's understandable. I hope you find it understandable, that you can understand it and you can read it. It's pretty simple. I try to set up my chart in such a way that I just look at it and I can tell what's going on right away. I don't have to do too many analysis. So that's how I like to have my chart set up. So thank you for watching. Please subscribe to the channel, and I will see you on the next video. Take care. Love you guys. Love you all. Bye.